of the curve start to scream. Now, 2-year yields are at some really important breaking points, but if that starts to happen, that'll be the sign that we have a curve play. So how are we investing in this? Look, the steepener's ongoing, we have no doubt, but what you tend to have is that the bull flattener tends to precede the bear flattener, and we want to look for the curve to flatten. And our trigger is going to be when we start to see 2-year yields start to head to the top side going forward aggressively, and we think that's a real risk. So number one, there's a curve trade to have. Number two, you want to watch where you are on the curve, and of course, if the data in the stock market holds up the front end, it's going to be important. And you get a lot of questions about should you be involved in bond ETFs. Be really careful about that, because look at the commodity space. The commodities have come out with ETFs, and now the commodity markets are much higher volatility than they've ever been. And the commodity markets, gold, silver, we all watch them, they're trading like a stock market now. So you want to have a bond ETF. Well, it's not really a bond proxy, it's just as much a stock proxy, and it's going to move with the stock market. So how do you invest in the bond market? You watch the curve, you watch the front end. We think you have to be bearish. There's some trigger points coming up, but what you've also seen, and again, make this a real-time environment, you've seen German rates have been, the spread has moved. German rates have been very bearish, UK rates have been very bearish, the US Treasuries have been kind of flat. That has reversed now, and it's mattered in foreign exchange, but the US bond market has gotten to be bearish, and Europe has actually started to slow down. The relative value spread is going to be very important, and of course the tips market. So there's lots of opportunities here, but you're just going to have to be specific and not be a blanket portfolio investor. You're going to have to modify your duration, not every day, not every week, but probably every couple of months, if probably what our economic team believes and what I think on the stock market, this data continues to be improved. It's good news. It's going to be great trades. Vol in rate space has been dead, but I think very strongly over the next couple of years, vol is really going to start to pick up. And again, it gets back to our point that we think we're all going to be bond traders within a couple of years.
So as a follow-up, the same question was stay short in duration and buy short funds like ETFs. So I guess the conclusion is we do exactly that.
If you want to invest in the bond market or trade the bond market, trade the bond market. ETFs are a stock proxy, and you overcomplicate what will be, I think, a very volatile situation for the next 18 months.
All right. So I think this is a sort of a change of tone in the questions, and I like this one a lot because it's sort of been, in our minds for decades in terms of what affects emerging markets. And the question is to any of you who would like to answer it, what is your take on the accusation of many developing and emerging economies that it is the World Bank and the IMF themselves and their lending policies that make it nearly impossible for the countries to ever climb out of debt and subsequently under the thumbs of these entities?
Oh, no, I completely disagree. I think what we've seen is really a change, especially in the IMF and the World Bank. As of late, and I say as of late, and I will couch that as the global banking crisis that we saw. Prior to that, we had an IMF that was basically out of work. A lot of these countries were on pay down debt mode, and as a result, the IMF really had a shrinking portfolio, if you will. They didn't have a lot of loans outstanding to these economies, and so I don't think it's the policies of the IMF to keep these countries at high debt loads.
I would be slightly more critical of the IMF and the World Bank. I think they haven't necessarily fully understood what triggers an economy to start growing. They've given advice to countries which has often been associated with tremendous fiscal austerity, which in turn has led those countries to remain extremely weak and feeble. They also gave advice in the 1990s to countries in Asia to get rid of all their capital controls, open their capital markets up for foreign investment, which led to all sorts of bubbles and instability and probably contributed to the Asian crisis. And actually the IMF has recently changed its mind, now saying, well, actually on certain occasions maybe capital controls aren't so stupid after all. One thing I would stress is that in parts of the world that had not grown in the past, some of those countries are beginning to grow, but they're growing for reasons that perhaps the West wouldn't necessarily like. I'm thinking here of the way in which Chinese investment is spreading through to parts of the world which were previously untouched by China, whether it's sub-Saharan Africa, whether it's parts of Latin America. And it's spreading for one obvious reason, which is that China needs access to raw materials and commodities. It worries that perhaps in the future it'll find it difficult to get access to those things unless it makes inroads now into its relationships with countries elsewhere in the world. And in the process of cementing those relationships, it is investing very heavily in the sort of infrastructure, whether it's docks, ports, railways, roads and so on, which those countries have desperately needed in the past. So you're seeing a connection being made between China and these other emerging nations, which appears to be lifting some of these emerging nations into faster growth rates than was the case previously, with no help whatsoever from the IMF or the World Bank.
Yeah, I think that certainly was more the case back in the 70s and the 80s, and maybe as late as the 90s. But I think as many of these emerging markets got their act together, monetary policy and fiscal policy, and some other things in order, certainly the role of the World Bank and the IMF diminished a lot. But I do think that in the periods of crisis, like we've seen recently, they can sort of step up to the plate and be back in business again. But
you can thank Greece for that.
Exactly. Anyway, you mentioned China, so there was a question here. Will the Chinese yuan appreciate more than 5% in 2011?
Against what? I think trying to make money in renminbi appreciation is incredibly difficult. The last thing the Chinese government wants is to reward speculators for significant bets. So the chances are that it'll be no. 5% is about all you'll get.
And as a follow-up to that, Steve, this was for you. You believe the renminbi will become the world's reserve currency. What do you make of all the China bubble talk?
Well, China can have bubbles from time to time in the way that other countries can have bubbles from time to time, but bubbles don't necessarily take you away from a long-term story. Let me give an example of a bubble. It's actually Japan's bubble, not the one you're thinking of. It's Japan's bubble in 1965. They had a big bubble after the Tokyo Olympics. The bubble burst, and for a year or so Japan stopped growing, or it didn't grow particularly quickly. It then rebounded incredibly aggressively and carried on growing much faster than other countries throughout the rest of the 60s, the 70s and the 1980s. In China's case, I think it's cashing up not just for 10, 20 or 30 years of lost opportunities, but actually for about 500 or 600 years of lost economic opportunities. China shut itself off from the rest of the world in the 1400s. It reopened for business in about 1980. So it's effectively cashing out for 500 or 600 years of lost opportunities, attracting huge amounts of good quality capital from elsewhere in the world. That good quality capital is mixing with extremely low-cost Chinese labor. It's a pretty intoxicating mix. And it seems to me that so long as China remains open for this kind of business, there's every chance of, whether it's got a bubble or not in the short term, it will continue to grow extremely rapidly in the decades ahead. Just for the numbers in this, China's per capita incomes currently per year are about $3,500, which compares with those in the US at $40,000. Even if China has bubbles from time to time, it's got a lot of cashing up to do.
Very good. I guess the last question following up on the theme of China. A question is, I've had clients ask me if China was the next Egypt. Any thoughts? What? Where's the question?
You want to go at this?
And there's a follow-up. Are dim sum bonds a good way to plan an appreciation in the Chinese currency?
Let me just deal with the Egypt thing. I guess the question is about legitimacy, whether the Chinese government has legitimacy in the same way that perhaps the Egyptian government hasn't got legitimacy. China's history has been one of continuous upheaval and revolution. When things become tough and life becomes difficult, typically the government of the day is overthrown. So in that sense, the legitimacy in China comes from the threat that if things do go wrong, then the government or the administration or indeed the whole political system is changed. So the key thing for China is, can it carry on growing at a reasonable rate? Can it avoid having a deep recession? I think the answer is probably yes. And can it avoid too much inflation, which would be a situation which would lead to a big increase in income inequality, more so than we've seen so far. To date, to be fair to China, it's achieved most of those things over the last 20 or 30 years. My suspicion is it will carry on achieving those things, so I don't think it is the next Egypt.
Thank you. Okay, moving over a little bit to another asset class that you brought up earlier, gold. So the question is, what do you all think about gold, where it is and where it's going? We know it's come, quite a ways in anticipating inflation and other crises, but what do you all think going forward?
Okay, a couple of things. Every market has a pulse. If you trade, a market has a pulse, long-term, short-term, so you kind of want to follow the pulse of a market. And I kind of divide the markets, just for my own edification, into personalities. And I kind of think I have a vision. So for the interest rate market, I think of it as kind of like a wise old professor sitting back with a sober second thought. And I think of the commodity markets, it's kind of like the Jekyll and Hyde market. It booms or it busts, and that's all about all it has to it. And of course, I think of the foreign exchange market as like a 16-year-old who just got their driver's license. They're going to get from A to B, but they're going to hit heavy signposts and mailbox along the way. So when you look at the commodity markets and look at gold specifically, remember, the way commodities trade is the opposite of the way the equity market trades. So think of how equities trade. When equities top out, they tend to top out over time. It takes a long time usually to form an equity top. And when equities bottom, often they spike into a low or they bottom very quickly. Commodities are the opposite. So when commodities bottom, they often take a very long time to bottom. Think of natural gas, so those of you who follow Natty, think of gold before the year 2000. But when they top out, think crude a couple of years ago, it's a spike high and down we go. So why do I tell you that? If gold had topped out, if we had seen the top in the gold market, we would not be trading with a 1300 handle. We'd be trading with a 600 or 700 handle already. Now, I'm very much on record with our clients on television. We've been bullish. I've been bullish gold for 7 years. We're still bullish the gold market. We have no reason to think the gold market is not going to continue higher. Gold is not correlated with any other asset class. Gold is not a dollar move, it is not a rates move, it is not an equity move, no matter what you put on it. And I'll prove it to you. When you have a chance, look at gold for the last 10 years. It has gone higher 10 years in a row. It is the most unloved, unrespected trend out there. But no matter what you put into the gold market, the dollar, the stock market rates, try to run your R-squareds or just visually look at the correlation. If you had traded gold based on any correlation, how would you have done? Very, very poorly. Again, it gets back to the point of what's the message of the gold market? I don't know. I'm not concerned. Cause, to me, is a lot less important than effect. So we look at the